To discuss all of this and more is Jason Pry, Director of Investment Strategy at Glenmede, where he helps oversee about $18 billion in assets. It's been an interesting day so far on this program. Mark Faber was on earlier saying he thinks people should come out of emerging markets and into U.S. equities for at least the short term. He even likes U.S. debt for the very, very short term. Do you agree that the U.S. is the best place to be as far as equities are concerned?
Not necessarily. We're taking a fairly balanced approach there, and truthfully, we have been overweighting on a more secular basis the emerging markets, specifically focusing on the emerging market consumer, not just the whole emerging markets, and even overweighting Europe, where we think you get a very interesting discount right now in multinationals, which really have the same general geographic revenue exposure as U.S. multinationals.
And you have, though, a slightly longer-term outlook, I'm assuming. Faber was talking about, what, 10 days for bonds, 3 months for equities?
Right. And there's no doubt the U.S. economy right now is definitely shaping up better. You see the pitfalls in the European economy, and that's why that discount exists. We think it just sits at such an extreme now that it's worthwhile to start overweighting that area while still maintaining a healthy position in U.S.
All right, we want to talk more about that in just a moment. Folks, let's bring you, though, the closing numbers on this Tuesday, January 25th. Well off our lows. I'm not quite sure what has happened, though, in the last half hour of trading, but we have really erased most of the day's gains, enough so that the S&P 500 just barely ending in positive territory. Call it flat, but it was down for most of the day. 1291 here at the close. The Dow, which was down 81 points at its lows of this session, it too is pretty much ending flat on the day, 11,976. Let's also bring up the NASDAQ for you. It is also kind of eking out a gain here, just up about 2 points at 27.19. So definitely a little bit of a different tenor in that last half hour of trading. Let's bring in Scott Shellady. He's manager of fixed income at XFA Futures. He's over at the CME Group out in Chicago. Scott, tell me what happened here, because we did erase most of the gains. And again, I do love your jacket, but tell me what happened here. I mean, we're finishing near our highs of the session.
Well, you know, a lot of times on days like today, especially when we've got the State of the Union tonight and the FOMC meetings tomorrow or for the next 2 days, that's going to give a psychological kind of a no-brainer where we have sometimes a move like we had in the Dow today, down 80 and coming back to being unchanged at the end of the day. So you'll see a lot of times where we have fairly significant events on the horizon like tonight and tomorrow and Thursday that the market will do something early and then ultimately end up close to being unchanged because people are really unsure about what might come out of it. So the rumors that we had swirling around today caused the market to do what it did early, but then once people got a hold of themselves and thought, well, until it comes out, we don't know what's coming out, and we ultimately end up being unchanged.
All right, so your point is everybody got a hold of themselves in the last, 30 minutes of trading here?
Well, you know what? I think they got a hold of themselves a little bit earlier than that because the rally started a little while ago. But however, you know, what big position are you going to take going into tonight and tomorrow and Thursday? Right. I mean, ultimately, if you're short and you didn't cover early today, you're going to have to cover at some point, and you chose the last half hour. I think that's ultimately what rallied this market in the short term. Just because people are going to now not go into it with a big exposure, they're going to take a little bit off the table and make sure that they've kind of squared up, waiting to see what the president has to say and what the FOMC have to say. I
mean, Jason, you feel like a lot is going to come out of the Fed at this point and the president, or is it pretty much everything we kind of already know?
And we have jobs coming up, don't forget, on Friday.
We do.
I think the president's speech tonight and what's coming out of Congress and the president combined is absolutely key to determining a continuation of the sentiment improvement that we've seen since the midterm elections. You know, they have to continue the momentum, and if that momentum doesn't continue in a direction towards fiscal conservatism, then you could see a sentiment fall at the business level, which rolls to jobs, which rolls to the markets. Right? I think, generally speaking, that's the direction it's going to go. It seems like that's the way the president's pushing. Seems like that's the way the Congress is pushing.
You know what? I want to bring in Dom right now because he's looking at the State of the Union address. We're all waiting for that, obviously. What are investors generally looking for tonight, Dom?
Well, Matt, if you look at what's happening here, just take a look at a chart of what happened with 2-year yields. Okay, these are yields on U.S. Treasury bonds of the 2-year. That right-hand side is what you want to key on there. We kind of heard some headlines about possibly President Obama, freezing spending that put a little bit of bid in the Treasury market. Remember, when you narrow deficits and show some fiscal discipline, people want to buy your bonds more. And then the bond auction came out, all right? 3.47 was the bid to cover, 3.47 bids for every bond at auction. You saw that yield slide, kind of pull back. That means people are buying them up. Now, this is over. We get the 5-year note auction tomorrow, but it's going to really kind of happen with what happens with the State of the Union tonight, because if there are signs that we do show some kind of fiscal restraint, you know, guys, you could see some real pickups here. And maybe, Jason, you can maybe speak to a little bit to this here. Jason, if we do see some kind of real tangible action coming out from this administration, could we see a positive response in that Treasury complex, Jason?
I think you might be able to see a near-term positive response. The problem is on treasuries on the whole, we're now to levels where valuations are at excess. You know, we've actually started, and this started actually earlier last year, underweighting the treasury, the most conservative, lowest risk baskets within the portfolio in order to extend the risk other areas. Now, we're doing it in a conservative way. But basically, when you look at it, the long-term returns available in that space is not justifiable for majority of investors. So you need to shift in that direction. It could easily be a near-term pop because that shifts the fiscal position in the right direction.
We need to shift direction just for a moment, everybody, because Yahoo numbers are crossing as we speak. Jules, I'm going to toss it out to you. How did Yahoo do?
It looks like Yahoo is, surprise, surprise, beating estimates. I know Matt's shocked about that. The company coming in at 26 cents, backing out one-time items. 22 cents is what analysts have been anticipating. And fourth quarter, the revenue is also above estimates. I want to point out, though, it looks like the number that's going to be the most important in terms of how the shares trade is going to be the first quarter revenue forecast. And you can see the shares flipping into the red and going back and forth even as we speak. But the first quarter revenue forecast, $1.02 to $1.08 billion. The estimate for $1.14 billion. So obviously that first quarter revenue estimate is below analyst forecasts. Just to sort of frame the situation at Yahoo here, it is expected by most investors and most analysts that revenue is going to lag even as the profitability may continue to improve. Remember, Yahoo today announced another 1% in job cuts, 1% of its total workforce, in addition to the 4% of its workforce that it said it was cutting last month. This all part of CEO Carol Bartz's turnaround plan as she tries to make Yahoo sort of more lean and mean, if you will, and more profitable, and the margins to be better. Now, on that point, however, it looks like the first quarter income from operations is also going to be short of estimates. So not just the revenue, and that first quarter income is going to amount to $130 to $160 million. Analysts were looking for close to $202 million. So even the profitability looks to be suffering in the first quarter at Yahoo. I'll keep looking at the results here, see what else is going on, guys.
All right, and Jules, we are going to have more with one of the top analysts on Yahoo later on in the program. Right now, I want to talk to Jason about it, investor here. You guys have a lot of access to, I'm sure, every analyst on the street. They all get it wrong when you're looking at earnings, especially these tech companies. They all underestimate. These companies always beat. When you're looking for reliable forecasts, where do you go?
Yeah, so we actually look at it and track the historical ratio of earnings estimate beats to earnings estimate misses on going back in time, and that ratio is about 60-40 within the U.S. It's actually different in international markets and different than that in small caps. When we see the earnings season coming around, we're comparing against those numbers, basically building in an assumption that on average 60% of companies beat estimates, 40% miss estimates, and that's simply the way you adjust the numbers. Now that's different based on economic cycle too. When you're in the initial stages of a rebound in the economic cycle, you're going to have way more beats against those estimates than you're going to have misses, and vice versa on the opposite side. So the fact that throughout last year and even coming into this year, we saw way in excess of 60% of companies beating estimates is not that unusual. It's simply a verification that analysts can't keep up with every single revenue-moving item, and in fact, perhaps even restrain it a little bit in order
Especially if they're covering Apple, right?
There are definitely some companies that seem to consistently do it, but on the whole, 60-40.
So what do you get then, Jason, out of earnings season that either gives you more confidence in kind of the outlook or less, or do you not? Do you kind of disregard it on some level?
Well, we regard it to some degree. So we were running at about 78% of companies beating estimates in the previous few quarters. Now we're running, it appears to be 69, 70%. still above 60%, still indicates that we're in that rebounding phase of the economic and profit growth. But perhaps we're getting towards the tail end of and entering a more stable expansion.
Scott, let me bring you into this discussion. What do you get from earnings here? And are there certain numbers that you look at, certain numbers that you just throw away because they're always going to be better than the street's estimate, or that they're easily massageable, let's say?
Well, you know what I think right now is, for my own personal estimates, I think that I feel as though, like some of your earlier guests have said, I think we're troughing here because I'm getting some mixed signals, but the signals are a little bit better on the whole. If you take out our two non-farm payroll numbers and you look at what some of these companies are doing, I think things are definitely getting better. And I'm not quite sure about how much we really have to center on, say, the unemployment rate, because I'm not sure that these companies aren't more efficient. They're not going to hire back everybody that they laid off. They're doing a much better job on making money with less people. So right now, I think that with the numbers that are coming out, I think we're troughing and things are looking a lot better.
Got it right, Scott. Thanks so much, Scott Shellady there out in Chicago. Jason Pride here in studio. We appreciate you stopping by.